Repo market goes nuclear. How does this affect you? I'm going to explain it in 3 simple, fast steps. Step number 1, let's go over the numbers. Overnight repos yesterday, 103 billion. What's interesting about that is the amount of the repos are going up and up and up. In fact, the Fed committed to doing overnight repos up to 175 billion. Where it really gets interesting is we look at the term repos, the 14-day. 45 billion in transactions were done, but there was demand for 87.1 billion. So it was oversubscribed on the 14-day repos by 42.1 billion. Going on to the 25-day repos, 50 billion of transactions, 82.6 in demand, so 32.6 oversubscribed, giving us a total of 74.7 billion of oversubscribed repos. Remember, this is just a slice of the overall repo market. It's over 2 trillion a day. So we're using this number as a proxy for the oversubscribed or the repo fails in the broader market. So the Fed comes in the morning, sees the market falling out of bed, and says, whoa, time out, fine, we'll give you more liquidity, we'll print up more funny money. How about 500 billion in 3-month term repos, and we'll give it to you this afternoon. Additionally, we'll do another 500 billion in 1-month term repos tomorrow, so $1 trillion in total. About this time, I happened to be watching CNBC. I know, big mistake, but I saw Steve Lehman on there making the announcement. You've got to remember, this is totally unprecedented. And you could hear the fear in his voice as the entire market was like crumbling around him. It was unbelievable. You got to check it out. Editor, let's play the clip.
Scott, this is a massive move by the Fed coming into the markets in a very big way. I don't remember anything like this, approaching this in terms of putting $500 billion in a 3-month repo operation. And then they're going to come back tomorrow with looks like another 500 billion. I believe that's $1 trillion. I believe that's in addition to what they're already doing. Flooding the zone is understating what it looks like they're doing right here. And I'll quote from the release, Scott, they're saying, these changes are being made to address highly unusual disruptions in treasury financing markets associated with the coronavirus outbreak. And we had heard earlier today that there were pretty bad disruptions in the treasury market, Scott. We've been talking about that all week. We heard it worsen today. I was talking to several senior officials at investment banks, and they were saying the Federal Reserve needed to come in some way. I don't know if this will be considered sufficient, Scott, but I will tell you, everybody is waiting in just about 2 minutes for that 30-year auction to see how it goes. It's expected to go well. We'll see if it tails off. We'll see if it's all taken down. But that's the next big test with the Federal Reserve coming in a massive way into the repo market here.
Wow, Steve, big news. Thank you for coming to the phone. Stocks are certainly attempting to rally off of it. They're still down sharply, but...
Scott.
Yes, yeah, go ahead, Steve.
Here. One other line I just picked up. 3-month and 1-month repos will be, for $500 billion, will be offered on a weekly basis for the remainder of the monthly schedule. And I got to start doing the math as to how much they're putting in, but they're putting a lot in, it looks like, right now.
And if you're not shocked already by the $1 trillion, I went to the Fed's website yesterday afternoon and saw they committed to another 500 billion in 3-month term repos today. So in total, we have 1.5 trillion in term repos. Oh, but wait, there is more. The Fed is currently buying $60 billion worth of T-bills every month, in addition to what they're doing in the repo market. It's important you recognize T-bills. More on that in step number 2. But they're transitioning, per their website yesterday, from buying T-bills to all maturities of treasuries. So this transition, not really an Operation Twist, more like an Operation Caitlyn Jenner. The big deal here is since they're now buying and admitting to buying all maturities, they can't say this isn't QE because the definition, their own definition of quantitative easing is that they're buying the long end of the yield curve. So this is an explicit QE4. Step number 2, what exactly is the problem? To understand this, we have to figure out why liquidity is so important. We've got a typical balance sheet, very simple. The liability side, debt, asset side, collateral, and cash. This business has a customer that owes the business, call it $1,000, but it's got a debt payment coming due for $2,000. So they go right over to this gentleman who's looking very stylish with his hat, double R for Repo Randy. Repo Randy says, okay, I'll give you the $1,000 that you need if you give me some of your collateral. They say, great, fantastic. They have the liquidity that they need to make that $2,000 payment. Before, they only had $1,000. So if that liquidity wasn't available to this business, they couldn't make that payment. Potentially, they go bust. Then, when the customer comes in, makes that $1,000 payment that's owed to the business goes right back to Repo Randy, says, Repo Randy, here's your $1,000. We take the collateral back. We're good to go. So to make sure everyone is on the same page, if there's no liquidity for the businesses, the financial institutions, hedge funds, or banks, they'll go belly up very, very quickly. Let's take it another step and look at how the repo market actually provides the liquidity. The Fed has the primary dealer bank accounts. The primary dealers are right here and the banks under the Fed's umbrella. The Fed buys treasuries or the pristine collateral or mortgage-backed securities from the banks and deposits the funny money they print out of thin air into their reserve accounts. The Fed is hoping those primary dealers take the funny money, the additional reserves, and lend that into the repo market to other banks, financial institutions, and hedge funds. Let's look at the balance sheet for this hedge fund. Very simple, corporate bonds as assets and debt as liability. They can't take the corporate bonds into the repo market. They need that pristine collateral, preferably T-bills. They go right over to their buddies at Bank C and say, listen guys, we've got all this corporate debt, but we need the treasury bills. Can we do a swap? Can we trade you? They say, fine, whatever. So then the hedge fund takes those treasuries that they traded for the corporate bonds, puts them onto their balance sheet. The debt side, the liability, stays the exact same, but now they have fewer corporate bonds and they actually have the treasuries needed to go into the repo market and trade for the cash they need to make their debt payments. So the asset side of their balance sheet goes from having all corporate bonds to treasuries and corporate bonds to now cash and corporate bonds. In other words, liquidity. The problem is when the corporate bond market crashes, meaning interest rates go up, prices go down, the value of the assets the hedge funds have on their balance sheet collapse. To make matters worse, if they take those corporate bonds, go back to the banks say, hell no, we're not trading you that corporate garbage for our pristine T-bills. The hedge funds have one choice: sell their corporate bonds at any price, take a big haircut so they can go into the treasury market and buy the T-bills they need for the repo market. To explain this further, let's go to a tweet from Jeff Snyder yesterday. As crap collateral that infected the repo system gets repriced as crap, that herds repo participants out of the crap and into the pristine at any price. Let's take it a step further to try to explain to a lot of you that I'm sure are wondering why the price of assets like gold and Bitcoin, liquid assets, have completely tanked the last few weeks. Use the same example where this entity owes $2,000 of interest payments, but their assets include corporate bonds, which are now persona non grata because the bond market has collapsed. Bitcoin, $500, gold, $500, and $1,000 in cash. So they need an extra $1,000 of liquidity to make this debt payment. So they take the Bitcoin, the gold, they go into the market, they sell it off in exchange for cash. They take the cash, go into the treasury market to buy the T-bills they need for repo. Why don't they just take the cash that they receive from selling the gold and the Bitcoin to make their debt payment? Because it's not as flexible, believe it or not, as the T-bills themselves. They go into a negative equity position, and with the T-bills, they don't really have to send that into the repo market. Remember, the collateral stays on the balance sheet of the borrower. It doesn't actually go to the balance sheet of the lender. The net result is because the additional buying in the treasury market and selling in Bitcoin and gold market, T-bill prices go up, gold prices go down, Bitcoin prices go down as well. So we know liquidity is the key to keeping the entire house of cards from collapsing in on itself. But there's two components of the liquidity problem. First is what everyone's focused on, including the Fed, cash. Second, what nobody is paying attention to is collateral. When we look at the repo market, we understand there's two assets that are being traded from counterparty to counterparty. Not just the cash, but also the collateral. So the Fed could print trillions, quadrillions of dollars and deposit those dollars with the primary dealers. But if there was no collateral in the system whatsoever, there still wouldn't be any liquidity in the system. It'd be stuck with the Fed. And there's a lot of really smart people on Macro Voices and Real Vision who think this is really the problem. It's not just Jeff Snyder. And they point to charts of the pristine collateral. So editor, let's throw up a chart of the 3-month T-bill. We can see the price has continually gone down, down, down over the past 2 weeks. Also, there's two types of treasuries that we need to be cognizant of: on the run and off the run. The difference between the two, very simple. When the Treasury issues new bonds at auction, those are considered on the run. Everything else outstanding is off the run. Whoa, time out. I know this gets a little confusing. To understand it better, let's go to a clip from my full-length interview with professional bond strategist George Goncalves. You're going to recognize him from Real Vision. Let's go right to the clip.
It's almost like parallel universes. You have these two bond markets in a different dimension, but they're all kind of coexisting. There's a series of now 6 on the runs and soon to be 7 on the runs when they introduce a 20-year treasuries, most likely in May. But there's these points on the curve, which are the main kind of tenors, the main maturity points on the curve, which kind of people use to connect the dots and make a yield curve.
Right.
Those are the benchmark on the run securities, which are issued mostly every month, and some are issued on a quarterly basis and then reopened as an old version of the new one. And these on the runs treasuries are where most of the trading activity gets done for hedging, for macro bets on where you think rates are heading, how the curve is going to move. You use the on the runs because they're the deepest, most liquid ones that are actively trading every single day.
there's more liquidity with the brand new bonds because of the counterparties involved. They trade them back and forth very quickly, the hedge funds, the financial institutions. But the off-run bonds are less liquid because they're held in the portfolio of private individuals. So there's going to be a liquidity premium. In other words, the price on the brand new bonds is slightly higher and the interest rate is slightly lower. Therefore, there's a spread between the two. This is where it gets really, really interesting. Editor, let's throw up the chart. Back in 2008, when Lehman Brothers failed, we can see the basis point spread between the two types of bonds spiked all the way above 60 basis points. That tells us that there was a huge premium for the treasuries that were most liquid. Why? Because they can be used as collateral in the repo market. I'd like to point out that the average spread is about 14 basis points. The next question becomes, what was the spread yesterday when we had all these problems? It got up to 50 basis points, almost as high as the spread was when Lehman Brothers collapsed. Because the liquidity premium was so high, it shows us there was a massive amount of demand for the most liquid assets on the run treasuries. If we look at the Fed's actions, we can see they're also extremely worried about a lack of collateral. Going back to step number one, you recall they're buying $60 billion per month worth of short-term T-bills. This is in addition to what they're doing in the repo market. The repo market transactions are supposedly short-term, overnight or term repo. But the purchases of the T-bills, they're parking on their balance sheet. In other words, they're taking all the best collateral out of the repo market. They finally realized the unintended consequences, so they came out with the report or with the announcement yesterday that said they were Caitlyn Jennering from short-term T-bill purchases to the entire yield curve. This shows us that not only are the guys on Real Vision worried about this, Macro Voices, Jeff Snyder, but the Fed is as well. It's not just about cash. The liquidity problem is most likely even more so about a lack of collateral. Step number 3, the solution equals an even bigger problem. Remember, the Fed can only create reserves. They can't create additional collateral. The only entity that can do that job is, you know it, the government. Your insolvent Uncle Sam. That's right. He can create all the additional T-bills needed to go into the repo market by deficit spending like a drunk sailor, spending all that funny money into the real economy. We get into MMT and helicopter money, but you guys know well from watching my videos, inflation equals the money supply plus velocity. But there's one thing I haven't talked about, and insert the cerveza sickness. That could reduce supply dramatically. So even if velocity is going down or remaining consistent, if the amount of supply is going down at a faster rate, we still could see price inflation. Okay, well, we've got that. Now let's take it to the next step. The yield curve is what the Fed and the government has to pay a lot of attention to because there's a distinct line in the sand. They can't allow the 10-year treasury, the interest rate, to exceed that line. It gets into what I call the no bueno zone. If the 10-year goes that high, it wreaks havoc on the economy. And this is excluding what's going on with the cerveza sickness. So how would the 10-year interest rate start to creep up and up and up? Because of the inflation that's created by your drunk, insolvent Uncle Sam spending money into the real economy through MMT and helicopter money. But that's not all. Your insolvent Uncle Sam is also the largest subprime borrower in human history, and he doesn't have a 30-year fixed rate loan. It's an adjustable rate mortgage. So most of their debt is very short term, meaning they have to roll it over and over on a yearly basis. So if they have 23 trillion in debt and their deficit spending, the deficit goes from 23 trillion to 30 trillion to 40 trillion. Who knows how high it would go? And it would require the Fed to keep rates at the short end of the yield curve as low as possible so the government can continue to roll over the debt without imploding. The takeaway is the Fed would not only have to buy the short end of the curve, they'd have to buy the entire yield curve, taking their balance sheet from 4.5 trillion to 10 trillion to infinity and beyond. The bottom line for every one of you watching this video right now is most likely, and again, there are no certainties, only probabilities. But in my opinion, what you'll most likely see in the next couple months or next 6 months, prices of the things that you buy, such as food, going up, prices of higher ticket items like cars going down, and prices of assets, excluding treasuries, going much, much further down. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.